With banks paying next to nothing on the cash in your accounts and the stock market dropping, deciding what to do with your money can be especially confusing right now. If you feel me, get ready for some clarity, because one of the most historically boring investments, I-bonds, has become an exciting option, now offering a 9.62% guaranteed return. Prices everywhere are up and the cash in your bank account is losing value every day, while the average savings account only pays 0.07%. On $10,000, that's $7 per year. That same $10,000 in an I-bond will get you over $900 if rates stay around near where they are now. Today, I'll help you understand what you need to know about I-bonds so you don't miss out on this rare, low risk, high reward opportunity. The reason why buying I-bonds is a great option, especially now, is because the return they offer is near the historical stock market average of 10%, without the risks and uncertainty that come with investing in the stock market. Locking in a 9% rate of return means you can make some money even if we fall into a recession and stocks crash further from here. Let's cover the basics so you can confidently decide if I-bonds are for you. Their full name is inflation-linked savings bonds because they're designed to pay out enough for your savings to keep up with inflation so your money doesn't lose value as prices increase. In the past, the average interest on I-bonds has been around 3%, so it may be why you haven't heard about them until recently. Now, let's get into some of the key rules with I-bonds. Each person is allowed to buy up to $10,000 of I-bonds per year and an additional $5,000 if you use your tax return to buy when you file. You don't have to invest $10,000. You can actually start with just $25, which is great if you're saving for shorter term goals. Keep in mind that another rule with I-bonds is the money needs to stay in the account for at least 12 months, and you lose the last 3 months of interest if you take it out before 5 years has passed. Even with this rule in place, it's still a great return considering there is no risk of loss, really. Since it's tied to inflation, this rate is reassessed every 6 months in November and in May. Even if you buy closer to November, like September or October, you'll still get the 9.62% for the 6 months from when you bought in. And I'll run the calculations for how much you'll earn in different scenarios towards the end, so stick with me for that. Once you buy your I-bonds, you lock in the current rate for the following 6 months. Now that we've covered some of the basic rules of I-bonds, let's get into the pros and the cons. The major advantage is this high interest that's currently being paid with basically no risk. If you have extra cash sitting in your savings account collecting dust, but you don't want to invest in the stock market, I-bonds are a great alternative. Another advantage is they're a great place to invest for shorter term goals like a house down payment or anything else you'd want money for in the next few years that you don't want to risk in the stock market. Another advantage, you won't lose money from your I-bonds since they're backed by the full faith and credit of the US government. The big downside is that you might make more investing in the stock market than you would from I-bonds. Here we see historical and average returns from the NASDAQ following a bear market, which is what we're in now. 22% is the 1-year average return, which is significantly more than you'd get from an I-bond if you can stomach the risk. Another disadvantage is that your money is in a sense locked up for 12 months. You need to have confidence that you won't need what you're investing in the next year. Something else to consider is that you can't buy I-bonds from an investment firm. You have to go directly to the Treasury website, so it's another place you'll need to keep tabs on. Let's take a quick look at the site where you'll buy your I-bonds. When I first saw this site and heard about these rates, I was skeptical and really thought it was a scam. But after doing lots of research, this is the official government website and the only place to purchase your I-bonds. Once you're here, you'll scroll down, you'll click apply and enter your information, which includes connecting your bank account. You'll follow the steps and you'll get an email with your account number, and you could use that to log back in and purchase your I-bonds. Now, if you know you're not gonna invest in the stock market with everything going on currently, then it's a no-brainer to buy some I-bonds instead of leaving that money sitting in cash. However, if you've got the courage to buy into the stock stock market, then you could potentially earn a lot more than that 9%. That, of course, comes with the risk that the stock market drops further and you lose money. Let me know below if you think stocks are going to go up or drop further from here. If you feel torn and unsure of what to do, then you'll definitely benefit from my free 3-part training that'll teach you how to get started with investing to grow your wealth. I'll be sure to link that free training below in the description box, so check that out. Let's dive into the numbers so you can understand how the rates translate to dollars you'll earn under different scenarios. Keep in mind, these are estimates, but you'll get a basic idea of how much you can make in different circumstances. I'm going to use $10,000 as an example starter amount. If you're starting with less, that's fine. Just use the same rates I share and substitute your starting amount wherever I use that $10,000 to find your own numbers. If you purchase I-bonds before November of 2022, you'll lock in the current rate of 9.62%. You'll divide this in half since it's locked in for 6 months at that rate equals 4.81% for 6 months. If you buy $10,000 worth of I-bonds, you take $10,000 times 4.81, and that would equal roughly $481. Add that to your $10,000 and you have $10,481 after 6 months. This part is the only true certainty we have for now, but let's look at a couple of examples of what happens if rates stay the same and also if they decrease when the new rate is announced. First, let's calculate what you would earn if rates stay at 9.6% when the new rate is announced in November. Again, you'll receive half of the rate for the following 6 months, so 4.81%. Since you already got paid on your first 6 months of owning the I-bond, your new starting balance is now around $10,481. This is the amount that the new rate will pay out on. To find the dollar amount you'd earn in the second 6 months, we take $10,481, multiply it by 4.81%, again, since rates didn't change, which would now equal $504. Thanks to compounding growth, we earn more in the second 6 months than we did in the first because our starting balance is higher. We add this $504 to $10,481, and you'll have $10,985 after 12 months. This brings your total gain to about $985. Currently, the Fed is raising interest rates in order to try and reduce inflation. If they succeed at reducing inflation, I-bond interest rates will go down since they're tied to inflation. Let's calculate what it would look like if they went down to what they were in the prior 6 months that was set in November of 2021, which was 7.12%. We'll first divide that by 2 to get the 6-month rate of 3.56%. I think something like this is the most likely scenario for your second 6 months, but it's really unknown. Starting with $10,481, which is what we know you'll have entering into this second 6-month period, we then multiply that by the new rate of 3.56, which equals $373. We add that to $10,481 for a total of $10,854 after 12 months. Now, since you may not want to keep your money invested in I-bonds for 5 years, especially if inflation drops significantly, let's look at what you'd make if you take your money out after 12 months. If rates stay the same, we know the second 6-month return would be around $504. To find the penalty, we divide that by 6 to get the monthly return of about $84, then multiply that by 3 since 3 months of interest is the penalty for taking money out prior to 5 years, and we get $253. This is what they'd withhold when they send you your money. Since you'd still get 3 months of interest, we'd add that to $10,481 for a total of $10,733 for 12 months. $733 would be your return, factoring in the penalty. This over basically nothing from your bank is still a really great option. If rates go down to 7.12, as I showed earlier, in what I think is the most likely scenario, and then you take your money out after 12 months, you'd lose $186, which is half of that scenario's 6-month interest. We subtract that from $10,554 and you'd have $10,668 after 12 months. $668 on $10,000 is equal to a 6.68% annual rate of return. This is about the lowest I think you'd get after investing in I bonds for a 1-year period, but you could get less if inflation comes down quickly before November. If rates do start dropping and you can wait a few more months past when the lower rates are in effect for you, then the 3-month penalty will be less since it's based on the last 3 months of interest you're entitled to. All right, that was a lot of math and my brain hurts, but let me know in the comments if you like seeing the numbers broken down. I think it's worth calculating so you know what to expect, especially in a time when so much is unknown. I bonds are an amazing option for you to make some money on cash that would otherwise sit and lose purchasing power in your bank account. They're not a great way to grow your wealth since they're literally designed to help you maintain your purchasing power. If you want to learn more about investing to significantly grow your wealth over time, grab my free 3-part training linked below and I'll help you create a solid investment strategy for your future. Let me know in the comments if you have any questions. If you're interested in investing more aside from I bonds or retirement, you're gonna need a brokerage account. So watch this video next that'll help you earn more potentially than you'd get from your I bonds. If you do want help with investing in your retirement account, I've got you covered here too, so check this out. Thank you so much for watching and I will see you on the next one. Bye.